Greetings once again, and happy to have you here. If this is your first time, welcome, and if not, then welcome again. Glad you came back, and I hope you pick more today, more than you did, or even better. So this is our fourth episode of our first series on understanding SACCO credit. Now, we've been doing this series before we delve into other issues around SACCOs, and one of the reasons is because we realize that there are some terms that are used that are not familiar to everyone, and I thought demystifying some of these terms will make it easy so that we understand why credit, and particularly why SACCO credit in this series. And so we have talked about what happens when you join a SACCO. We have defined terms like shares and the different types of shares in SACCOs. We have also looked at membership. We have also looked at SACCO credit and how different SACCOs, not gone into the details, but how they price their products, the interest rates, and we've compared that to the dividends that you earn, so that we look at the net value of servicing your loan, the net cost, the effective cost of servicing your loan, as opposed to looking at the interest and the dividends in isolation. So if you have not watched our previous episodes, please go back. We've only done 3 so far, and this is our 4th. And I hope that you pick something, so that as we continue in this series, you also continue to understand why some of these systems exist and how they are placed wherever they are to better you as a borrower, as a member, and as a customer. So today, I promise that in this episode, I would look at how to become a strategic borrower, because we saw that there's some people who are merely participating in the SACCO system. You have your monies there. Can you picture this? You have a SACCO has 1 million dormant customers. Each member has money that they've not transacted with, or money that they have that has been lying in their account for some time. So even for a year, you opened an account for some reason, but you are just there. That means you're participating. You are not positioned, because one day you will need credit. Maybe, you likely need credit. So SACCO has got 1 million members, or people who just opened accounts, put in some minimum amount and forgot about it. 1 million members, if each member deposited 1,000, that is 1 billion. 1 billion that you have given the SACCO. To you, that 1,000 is nothing much, but to the SACCO, collectively, that is 1 billion. How much can it do with 1 billion? A lot. And what happens? That 1 billion in the SACCO generates money. It generates an income for the SACCO wherever they've invested it. Now, that money comes back as interest. That is what is paid to to members who've positioned themselves as dividends. That is where we talked about share capital and member deposits. So that 1 billion is earning someone money, and if the same person who's earning from that 1 billion borrows, then their dividend cancels out with the interest that they are paying, and that's how we saw that the effective cost of servicing their loan reduces. But you, the borrower who went dormant, your 1,000 is just lying somewhere, and you think it's just little money. It's doing no one any good. And when the moment comes where we say that you may need to borrow, you come to a SACCO and you, for some reason, cannot get a loan because you did not save with them, because your account has been dormant, you somehow need to activate it, and other stories, and get a statement from this other place. What we are saying is that borrower who is earning from the money that you just kept dormant is a positioned member, while you are a participant. You're just escorting others, to make better money and to reduce the cost of servicing their loans. Now, when you require to borrow, you're expected, you might be told, you need to save with us for a few months to prove that you can repay this loan. But it looks so plastic. Imagine being told, save for 3 months so that we can see that you can be a good borrower, you will be a good repayer. It can be discouraging. That is why you'll see that you hop from one institution to another trying to get a loan. But do you know that consistent saving on those sunny days, 100 shillings per day, 1,000 shillings, hundreds of thousands, will save you on that rainy day when you need to get that advance, that money. So this is why we talk about positioning yourself. And this is also why I promised to bring the topic or the episode on how to become a strategic borrower. Now, the obvious things that we know about is for you to become a strategic borrower, it starts by the need for which you need the money. It's not a want in this case now, it's a need. So understanding that this might be necessary for you to borrow means that you need to save consistently, not big amounts, save consistently. If you can, don't just deposit, withdraw, use that money, let it come back, let it look like, and the idea is not look like, but actually that money should be working for you so that when they look at the system, it is clear that you're doing something and your money is generating some more. Zinatoka, zinatafuta zingine, they come as a bigger crowd or a bigger team. This is just like algorithm now. We've learned of algorithm on Instagram, on TikTok, even on Facebook. We know some algorithms are stronger than others. Some are more stubborn. So it's the same even with borrowing in financial institutions. And today we're talking about SACCOs. You should cheat. It's a cheat code, the algorithm, through consistent saving, so that you skip that first evaluation step when it comes to evaluating you for loans. You become more qualified. And then now we also have timing. Timing is another critical thing. We have timings around loans, and that is why you should not borrow because you can or because you need something. Borrow because you want to advance something. This is basic financial literacy, You should borrow not to service wants, but to service needs. That means your borrowing is timed. You have planned for it because you knew I needed to do this. Some may come randomly, but at least let other behaviors before then show that you didn't just wake up one day, no records. We are slowly moving to alternative data, yes, but before we get there, can you also try to improve our track, whatever track you're living, and that is so that when it comes to borrowing, you time your borrowing. You time your borrowing around your needs and not wants, and this is when your ability to repay is also very strong. So that is another thing. And we've talked about building good saving habits. And then I'd also like us to know that we said that your position in a SACCO as a borrower or as a member is a net of your consistency and your behavior around it. It is a net product of how you behave and handle credit. So when you borrow, make sure you can repay. It is not always guaranteed that we can repay when we borrow, but we can, to a large extent, position ourselves to repay. You don't borrow when you don't know how to repay. That means starting with purpose. What are you borrowing for? So if you borrow and repay well, then you become you're stamping your authority as someone who's credit worthy, so that when you go the next time, and I know we all know how this operates, if you want to say limits, these mobile loan limits, the more you borrow, the more your limit goes, and I think the better you repay also, then the better your limit becomes. It keeps on increasing, because these people, you've proven to them that you are a good member, you are a good borrower. That means you repay well. So it's very important to protect that repayment reputation, so that when you come the next time, then it's easy. You're building, in fact, it's building a portfolio. Just like you build your work portfolio, build your portfolio around credit becomes easier. Because remember, we are not borrowing to defraud the bank or the SACCO. No, we are borrowing to improve ourselves. And we cannot improve ourselves if we have not been faithful borrowers, because that means that you defrauded the bank, or the SACCO, which is a bad behavior, because you not only cancel yourself out of borrowing from SACCOs again, but you also, right now, even SACCOs are using CRBs. That means I think most of them are listing on CRB, good and bad. Before, CRB was only listing bad borrowers, but now we have everyone, so they can see. And this is why everything is moving, like I said, towards risk-based lending. That is RBL, because they're now trying to score everyone. This is a medium healthy borrower, this is a very healthy borrower, this is a very poor borrower. So your repayment behavior, it's a loop, literally, that, like we said, it's a financial loop. So it comes around. So be a good borrower by being a good repayer. Now, the other thing that we look at in this, as we look at how to become a more strategic borrower, is borrowing below your maximum limit. Just because you can borrow 1 million doesn't mean you should. Aim to borrow below that amount, but also address the need for which you're borrowing. This comes in financial planning. Like I said again, we are trying to educate ourselves and better ourselves as SACCO members. We want to be more knowledgeable. And like I said, SACCOs they operate in two key areas: savings and credit. We said we have investment, we have insurance, but I am focusing on the savings and credit. Savings influences credit. So this is why, again, we are centered around credit. So borrowing below your limit is very critical, because your living room, some room, when you borrow the maximum amount, it means that in case of a small inconvenience, then you are somehow trapped. So it's also good discipline to borrow below the limit, because that creates a sustainable borrowing habit and a loop. So that was looking at how to position ourselves. And before we close this short episode, I'd also like to look at some of the knowledge gaps. I hope I can expand them someday in a future episode, but today I can mention them, some of the knowledge gaps in SACCOs, which is also very critical, because we know, now we already know how we can borrow, what all these terms and these amounts mean. But what if I borrow a loan and for some reason, unforeseen, I cannot repay it, maybe in good time, or I picked 3 years, I had the option of picking 5 years, and what happens? How do I get myself out? So you can decide, I want to get a loan. This loan product can go up to 6 years, but you decide, I'm doing well, I think I can use 3 years to repay. The amount you repay when you borrow for 3 years is, say, 20,000. The amount you repay when you borrow for 6 years is 10,000. So do you take the minimum? No, okay, we don't have a minimum, but do you take the 3 years that you feel I can manage these, or do you take the maximum period given? Of course, the interest rate, it will shift. There is implication for that. But did you know that you can actually take the 6 years? Yes, your intention is not to repay in the 6 years, it's to repay in 3 years. But on paper, you'll have the 6 years. That means every month, if you're supposed to repay in 6 years, 10,000 every month, if you repay 15 for the first, say, 1 year, and you feel like this is a bit of a stretch, or your business goes down, or your ability to repay in the same consistency decreases, then you have an option, because remember, your repayment amount that is agreed on that repayment structure or a schedule, which is a contract binding you and the SACCO, was 10,000. That means now you are paying 15. You've of course reduced the cumulative interest that you're supposed to pay by quite an amount, probably half. But you now can't pay that 15. You can go back to your 10,000. So that means you still have the 6 years. So that is an allowance that you have given yourself to repay. So sometimes, like we're saying, do not borrow the maximum amount you qualify for. Also, do not go for them. If you have a maximum duration and you feel you can repay before that duration, then always go for the maximum, but aim at repaying it at in a shorter period. And that is one thing that leads us to a knowledge gap that is rarely mentioned. Like I said, when you go to a bank or a SACCO, you won't be given you won't be given all the information, not because they're selfish, but you need to ask. And you can only ask when you are informed. If you're not informed beforehand, you are at the mercy of whatever information they can dispense. Because remember, you have someone was ahead of you waiting to be served. Someone is again waiting once you're served. So they have clients to serve. So it's good to know, to have an idea. Then you can go and ask those questions. So one other thing that is that is rarely talked about is restructuring. So we have loan restructuring. We also have refinancing. Now let me talk about restructuring. This happens if you cannot repay your loan in agreed terms, on the agreed terms, and you decide, you go and you restructure it. So the structure was repay in this duration at this interest rate, and other terms, and then you feel this is something has happened, I can no longer service this loan like I was. There is room for restructuring. Go to, like we said, SACCOs are formed around mutual, it's a mutual thing, it's a community thing. It is not cast on stone, and that's why we say they have the autonomy, and they're not bound by some of the regulations that bind banks. So you go and talk, let them know what challenges you're facing and why you cannot repay at the agreed terms, and these will be altered to accommodate your current needs and challenges and everything. Of course, again, also it's a mutual agreement. You're not going to tell them, now this loan I was supposed to repay it in 6 years, I feel like I can't repay it, I need 20 years. That is not the case. It's mutual, again, also based on their terms, because every SACCO has got policies, SOPs that they operate under. So that is, again, something that most people are not informed about when it comes to borrowing. So you think it's cast on stone and they're following your guarantors and, embarrassing you every day. No, you can go talk it out and understand what can be done. And then, again, we have understanding how guarantorship works in SACCOs. This is something very key, because being guaranteed is very easy, but sometimes being a guarantor is not. Sometimes some people don't even want to be known that they are members of certain SACCOs with shares in that SACCO, because if my neighbor knows, or if my colleague knows that I am in this SACCO and I have shares there, they will ask me to guarantee them. I don't want, because I don't want to tie my shares to someone else, life behavior. So if X borrows 100,000 and I guarantee them 20,000, if they don't repay, then my 20,000 is locked. So even if I wanted to withdraw that, you cannot withdraw that 80,000. If you guarantee someone 20,000, you still need to, you need to prove that whoever guaranteed can pay. So guarantorship is another critical area, because when someone is getting a loan of say 300,000, they need guarantors who can cover that loan amount. And usually we have a minimum number of guarantors, again depending on the SACCO. Some SACCOs, mostly they'll need 3 guarantors. So your 3 guarantors should, the total amount they guarantee you should sum up to the amount that you have borrowed. So that means that that amount they have committed is tied to your repayment. And this is where now, as a potential guarantor, not as the borrower, you need to understand the person that you're guaranteeing. You cannot, some people will guarantee family and they'll fail them. Some people will guarantee friends and urafiki unaisha, you know, people cannot look at each other because I guaranteed you, you did not repay for some reason. And maybe you thought someone was good, you know, a credit-worthy person, and then your money is tied because they did not repay. So also choosing who to guarantee is very important, because there's a lot of conviction that comes around that time when someone is borrowing, and you can easily sign up for them, you know, give your ID, sign that, yeah, I guarantee this person this amount. Then when they fail to pay, you're part of the people that are pursued by the SACCO because you guaranteed them. You know, I'm guaranteeing you. When you buy a product and it's guaranteed 20 years, you follow, you go to them if it doesn't perform, if the motor say has a problem, you'll go to them because they told you, we are giving you a guarantee of 20 years. So it's the same even with SACCOs. As you guarantee people, be very careful, because it can determine, sometimes it's as bad as not even being able to withdraw your savings, let alone your shares. So if someone owes us money and clearly they have refused to pay, we follow them up, they keep on playing games on us, we will follow the guarantors. We need to understand, where is this person, why are they not repaying? So be careful of who you guarantee, otherwise it will not only tie your money, but it could also affect your reputation, because these are things, there's a lot of things changing, and they may not all be put on paper, but you might find yourself on some listed on some areas because of guaranteeing someone. So it's also very critical that you guarantee someone that you understand and that you can work with. And that takes us back to the idea of SACCOs, which is it's for accountability. It is a communal thing. It has its way of operating, which is different from how banks, traditional banking institutions, would otherwise operate. And this brings us to the end of our 4th. I know in one of the episodes, I think the 3rd one, I mentioned that the 4th would be the last, but I realized that there's still a lot, and also the questions coming up from the various platforms are showing us that we still have gaps. So I wanted to address some of these things very clearly and say that now this is our 4th but not final episode. So I hope to see you on the 5th one. Keep the questions coming, the concerns, the critics, and even the input, so that we are all on the same place when it comes to understanding our SACCOs, SACCO credit, our borrowing, and everything around it. I have been your host, Lynn Motweri, and this session has also been powered by YFS Analytics, the partner for SACCOs in everything data. So YFS offers training services, offers consultancy around data, tracking your portfolios, whether staff performance, product performance, loan performance, and also scoring, credit scoring. Thank you so much, and see you on the next episode.